Hey guys, Mike here. So the Fed has officially pivoted and said, you know what? Inflation actually is a problem. Like they just realized it's a problem, right? And they're not getting under control. And so they're going to go more aggressive now. It's like, wow, so that leak story, it was true. Hey, I admit when I was wrong, I was going 50 basis points. But the sheep has changed their clothing, right? That I guess a good guy on January 1st, today is a scumbag. They've changed how they do things. It's like, wow, look at that. I can't believe it, And so amazing how that works. And I swear when I heard him talking, I just kept thinking, him and his cronies have to be so out of touch with reality. I guess they got their nose stuck in textbooks or whatever, but I'm like, do they ever really get out in the real world? Because if you got out in the real world, you would see months ago that it was a problem, right? But it took them this long to realize, wow, we might need to get a little more aggressive on this thing because our tools are limited to begin with. And so, just looking at that, and so, I thought it was going to be 50, but they changed their, colors and stuff, and here we go. We're going to be more aggressive, continue to roll off the balance sheet, and understand, what we talked about yesterday, how is this a setup? Like, the market's selling off trying to price in 75, but, when we showed you this chart yesterday, so as we talked about yesterday, what was going on? We were going this channel, and right there at the bottom of that channel, what happened? We bounced, right? And then today we hit the support line, bounced up again, and what's above us? You got those gap fills, right? And then when we talk about the VIX, look at the VIX right there. Had rejected off that 35 we talked about, and then was rejected off 35, and boom, there it is. And don't forget to hit that like and subscribe button, guys, if you get something out of this. And I only bring this up again just to make sure, if you didn't see it yesterday, that if you're thinking about panic selling out of positions or whatever, because you think it's going to continue to go lower and lower and lower, make sure you look at the chart, see where we're at, see what's going on. Is this, because look, the market is totally manipulated. It's run by algorithms. That's just the way it is, whether you like it or not. That's the way it is. And when you hit support levels and the bottom of channels and all this stuff, that's what you see happening, and it happened on the penny almost. And so remember, when all that stuff's happening, they're just trying to price in the 75 basis points, right? That's what they're doing. And so, and what does that mean? Really nothing. But they're just going to sell it off, okay? And then all of a sudden you see these rallies, and you got to ask yourself, wait a minute, can this be a sustained rally? Like, why would the market have a sustained rally? Actually come out of this downtrend and go into an uptrend. Why? The man just told you today they're going to start taking liquidity out of the market even faster and make it more expensive for companies and private companies, publicly traded companies, to actually raise money, okay? And make it more expensive for us to get a home or a car or whatever, student loans, whatever you're getting. And so that's not good, but also they got to get inflation under control, right? They got to do it, and that's going to take time. That's not going to happen overnight, okay? These prices didn't go up overnight. They're not going to come down overnight. And so all that's going to weigh on the consumer, and it's going to weigh on companies. And publicly traded companies, at the end of the day, what it's all about is earnings. That's what it's all about. We can move off news all day long, but if those earnings don't stay strong, companies continue to guide down, the stock market's going down with it. Can this be a short rally? Absolutely. We see that all the time, right? These crazy rallies. And so we'll see about that. But then again, if you're thinking about panicking out, look at what's going on. Take a step back and look at it, okay, before you hit that button. And so, here's what he had to say, and make sure you pay close attention to the two charts and where we're heading.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. And projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now.
And to do some quick math on this, and I've read this and I've heard this from multiple people, which is every time you raise the rates by 1%, it's like an extra $300 billion on just the interest on the debt we have to service. And so if they go as high as they want to go, it's like between anywhere from $900 billion to $1.2 trillion, which is more than we spend on defense every year, which we spend over $800 billion. It's a lot of money. And so just imagine that. And that's why you think yourself, are we really going to get that high? I can't imagine we're going to get that high. And I think they're going to grind the economy down to such a slow halt. And again, we haven't been over 2.5 in a long time, it seems like. So, and we can't sustain it once we get there anyway. So why would we be able to do that now when the debt is double what it was the last time we did it? And so, could be wrong on that, and we'll see. That's way down the road, though. Let's just, go month by month and see what they do. But, the message is clear. Suppose they're going to be more aggressive, and that's just the way it is. Get out of the way, okay? But for us to go on some sustained run, it would make no sense. That don't mean it can't happen, but I see nothing in economics or any kind of data that shows that. But what I am looking at, like a hawk, is going to be looking at unemployment, which of course I'll keep you updated on, because you do get now all the crypto companies, they're announcing layoffs. More real estate companies, anything to do with real estate, is announcing layoffs as well. And so we have to look at it and see what Amazon, Walmart, all the big companies start doing. But and the other one's going to be the 10-year, 2-year, or 2-year, 10-year, however you want to say it, because I think it went negative again. But the more times it goes negative, as you can see every time, the more times it goes negative, the closer we are to a recession. And so I'll keep you updated on those. Tomorrow we got jobless claims, I believe, as well. We'll see how the market reacts to that. And so, if the job market keeps staying hot, the Fed is going to keep, grinding that wheel tighter and tighter. And so we'll see how it goes. So hope you got something out of this. I'll come up with a more detailed video tomorrow on certain things, and we'll go from there. So have a good one. Let me know what you think down in the comments.